So guys, it's our privilege to have Vishal along with us in this session. These are what we call script boxes, uh, expert speak webinars where we talk to an industry expert about the markets. We've had a few sessions on these, and I hope some of you who are here have also attended those. And Vishal probably represents the word expert best. A man with tremendous years of experience, having been with American Express, Standard Chartered, and now leading IDFC over the last 4 years. So without much ado, I'll pass on to Vishal soon. The topic for today's discussion is trying to get a better understanding of this apparent disconnect between the economy on one side and the markets on the other side. Post-COVID, we all expected to have a huge impact on multiple fronts, obviously on the health and social impact front, and that leading to an economic impact, and probably that leading to an impact on the capital markets. But what we've seen, obviously, is that while the economy is recovering, but is also has been impacted, the capital markets have recovered very well. So to hand over to Vishal to get us your thoughts, what are you seeing? What could be the possible reasons? So we'll talk about the current situation and then maybe a little bit about what we see in the future. But let's start with that, Vishal. Over to you.
Sure. Thanks, Atul. I know this session is called Expert Speak, but I must say that I'm still a learner, still trying to make sense of all of what is going on. So we try and share some of our house views as well as some of what we picked up. But by all means, this is not to suggest that we know anything more than what everyone's trying to grapple with, which is a big unknown. Having said that, I think if we just look back at the sequence of events and the question that you posed in the area that we're discussing, one must recognize that the lockdown was harsh, maybe needed to be harsh and quite severe, and it did bring economic activity to almost a standstill. Now, what that does is that it puts a lot of pressure both on the demand side as well as the supply side. On the demand side, firstly, one has to worry as a market participant about demand being deferred, which is that if I wanted to consume something, I simply can't because I'm locked in at home, and therefore I will just postpone my decision and once things normalize. But the larger factor has also been demand destruction, which is things I wanted to do that I can't do and time has passed. So for example, like travel, entertainment, a lot of consumption, this is just gone. That's gone forever. So the impact on economic activity on the demand side has also got shades. And I think destruction of demand is something we have to worry about. Of course, let's hope that the deferred demand is something that aids the pickup when it happens, which is where we get into forecast for the following quarters and maybe some years in the future. But it's also not just the demand side, it's also the supply side, as we all recognized. So on the supply side, once we've seen all these images, very painful images of laborers and migrant workers walking home, etc. It's such a large dislocation. The supply chains, the labor available to various industries when we reopen has been short. There are some reports about financing not being available or the supply side with the supply chain being disrupted, as well as factor input being disrupted, as well as we open, we must recognize that there are many still for people to work on, social distancing norms, etc. So productivity is not at the same level. We must for an economic contraction, and something that certainly much of our generation has not seen, which is why I'm saying we must be open to learn, because contraction in GDP, which is what every expert has been forecasting. So just to give us a sense, the IMF's forecast is that global GDP will contract by 4.9% before it rebounds sharply, though, but it does contract 4.9%. Our estimate is that Indian GDP may contract 6 to 8%. Which is severe, which is something that we haven't seen, but yet that's something we must just be cautious about going in.
Thanks, Vishal. So So obviously, thanks for your insights on the economy and what's likely to happen in terms of demand. And how do you think this affects the capital markets, right? Because capital markets have, after obviously the February March shock, have recovered. And what could have led to that? And what does the investor, common investor, sort of make out of that? And what should they be doing in this situation?
Right. So, when we look at capital markets, and specifically talking about equity markets right now, we have to keep in mind that the equity markets always look ahead. So we are trying to see at least 2 to 3 quarters ahead. If you look back, the biggest fall happened within a few weeks in March. And in March, this was even before the lockdown had actually, started off, and economic activity, at least the numbers weren't that bad. And, the number of cases, etc., had just begun. So in one sense, the market factored in already a large amount of this pain. Now, once you do that, the pain is behind you in one sense, and what is some of the good news, or what the market perceives as good news, percolating in. So what is that? Big contraction across the world. There was a huge amount of fiscal and monetary stimulus given by most central banks and most governments. And that is a huge plus for the market. So if the government and central banks are willing to backstop and push the economy along and take almost no holds barred sort of approach to managing this economically, that's a big plus for the market. The second is that the news flow after that may not have been as bad as what was earlier envisaged. So what we did see is that, fatality rates in March, if you remember, when the first, rounds were doing in Europe, were hitting 7-8%. Those are now down in India to, sub 3%. Globally, I think it's about 3.9%. India is much lower. So there have been good news. There are discoveries, there are new treatments, there's the hope of a vaccine very quickly. All of these have come in. So news flows have been reasonably positive. And third is, most importantly, at some stage, valuation becomes attractive. At March valuations, one may argue that a lot of people may find it very attractive, long-term investors, to come.
And sort of the common investor, right? So when the whole crash happened, we similarly did the expert speak conversations with ourselves. We presented to little knowledge we have, and sort of this too shall pass. And we launched something called the Smart Transfer Plan, where we said put money into liquids, and over the next 4 to 6 months, systematically let the money come into equity. Obviously there are questions: did we time it right? Did we not? And our sense always, and I'd love to hear your thoughts on that, Vishal, is that trust the fund manager, because he will take his calls. Because he's not investing every day. I mean, he's not just investing that way. So, what are your thoughts on that? In terms of sort of, if somebody's sitting on cash now?
Yeah, I think a lot of people may have been very worried going into March, and I think we received a lot of calls, friends, family, etc., panicking and wanting to pull out, etc. And that's the thing, and I think what you did for your customers may be absolutely spot on, which is that volatility is an absolute integral part of the market, maybe higher or lower. And during these times of volatility, systematic investments is a great way to sort of even it out, iron it out. And, that can be one approach where, people have benefited rather than just sit out of it altogether. So, if someone did look at that crash and the correction, looked at valuations and said, look, we don't know how quickly the recovery will happen, but let me spread it out over the next 3 to 6 months, then a lot of investors would be sitting on fairly reasonable gains out of this entire episode, I would think. What we must also remember is that the market, what we all look at a simplified version through an index or a number, is actually composed of so many different variables and industries. So it's not one picture within that one index number, right? So even right now, there are several sectors that can hugely benefit from what is going on. Some of these moves in places like healthcare, in IT, consumer staples have been reporting good numbers, of course, with everyone, being at home. But also there are other sectors like maybe discretionary capital goods, travel, tourism, hotels, etc., which may be adversely impacted. So for an investor, it's important to recognize that it's not, it's never one market as a whole. There's always slivers of opportunity. And to your point, let the fund manager, the experts choose those opportunities on your behalf. If you have a diversified portfolio, you're likely to get a good shot at some of these. So there's still a lot of opportunity in the market. One should not just go back to overall valuations and levels and just be dismayed by them.
Great. Thanks, Vishal, very much for that. And sort of, I know this is crystal ball gazing, but what's your outlook both for the economy and sort of gave a sense of that, and the capital markets, and your house view for say 4 quarters, and more importantly for the next 5 years. We tell our customers that trust the process. Scriptbox is all about remaining invested for the long term. Sort of the fill it, shut it, forget it. Obviously, monitor your portfolio and change as things change, but invest for the long term. But given these unknown times and unprecedented what's happened, what's your house view around sort of somebody, obviously it's people's money, they're nervous about market movements. So economy and sort of the markets, a four-quarter view and say a 5-year view. Would love to know your thoughts on that. And yeah, no, I'm not going to hold you to it, and will not. It's just what you think is appropriate.
Right. So, Atul, I think again, I don't know if we can really share a sort of accurate view. Like I shared, there are various hypotheses being put out in the market, and I do think that some may get it, some may not get it. So it's very difficult to be able to put an accurate there. I think what to get is what's the shape of the recovery and what are we seeing so far. And just to share some of the numbers. So of course, we expected unemployment to shoot up. It did shoot up to a peak of 27% in May, but actually it's back down again in June to almost pre-COVID levels. Now, that's a great sign, right? Power consumption is up. Again, many of these indicators are trending back to near normal. They're not at normal. GST collections, for example, those numbers came out for June. They're at about 82% of Jan levels. So it does mean that the recovery so far has been quite reasonable. There are some of the other indicators like the manufacturing PMI. It had crashed. It bounced back quite a bit. Services is still not bounced back, which is also partly understandable. But manufacturing seems to be well on the road. Some of the movement, freight, eBay bills, FASTag collections, all of these are now trending close to 80% of odd volume. So one way to look at it is that's the level of economic activity we seem to be back at. Spending. What's also helping is that the rural economy seems to be doing reasonably well. The Rabi crop output was quite good. The Kharif sowing seems to be well on track. So at least that part of the economy seems to be quite good. Therefore, the rural sectors, whether it's agrochemicals, tractors, fertilizers, two-wheelers, etc., some bit of that uptake, we're beginning to see in auto. Those may be, again, opportunities that, fund managers have begun to look at. It's going to also be about FY22 earnings, not so much about FY21. I think FY21 in many ways, people are only going to measure how far you fell and how quickly can you rebound. So in some ways, it's like how quickly can you get back to FY20 levels of earnings. And those who are able to cross 20 in 22, I think they might be generally seen as being back up, far more quickly. So the point I'm making is that while there is a lot of the headwind that we know from the economy, and by no means are we suggesting that the pain is all behind us. As we've all seen through the graphs, this is coming in waves across different parts of the country. So it's not as it's very difficult to say now we are open or now we are shut because it's at a local level. So some places are open, some places are shut. Therefore, we can't make a full assessment till everything is open, because right now there's just no picture available that tells us, what's going on. Having said that, I think while we are vigilant, while we are cautious about the level of pain, it plays out very differently in different markets. So in equity, of course, going back to growth, valuation, and some of the more time-tested principles of equity stock picking, I think will hold us in good stead. In debt, it comes back to saying what's the macro going to be like. As we all understand, the banking and NBFC sectors, the picture is very unclear because of the moratorium. So really, post-moratorium is when we have the full picture, and there are naturally some worries about, that picture not looking very pretty. But what's the extent of damage will only be clearer much later. So having said that, if someone's, to your point, looking at a 5-year view, which is what you should be doing as an investor, you have to go back and look at valuations and look at opportunities. Valuations are reasonable. In certain parts of the market, they're very attractive. And if you have a 5-year view, I would say, what are you waiting for?
True. Thank you for that. I mean, yeah. So just to reiterate what we tell some of our customers, and this endorses our view that while the markets are choppy, just be patient because anyway you need the money. You set this money aside for a specific goal. It could be children's education, it could be retirement, and if your asset allocation is aligned to that long-term view, this is a great time to be investing and remaining invested. Meanwhile, I mean, the request to everybody in the audience, if you have any specific questions you'd like Vishal to answer, please put in the chat window or in the Q&A, and we'll pick it up from there. I asked a lot about the equity markets, and we spent some time talking about it. What is your sense on the debt markets? And obviously, IDFC is very, very strong across both. But what is what is the house view on debt in general? The Franklin Templeton thing is obviously behind us, but looking forward, sort of on the which part of the yield curve, what are you thinking about in terms of debt in general as a category?
Right. So very interesting point, Atul, because we must recognize that while equity is very exciting and it's a growth area, debt is still the largest part of what the average saver holds, and therefore it's important to look at that very carefully. Often we sort of do the equity allocation and look at debt as the sort of whatever's left over. So first thing I would want to share with the audience is that you have to look at debt with an allocation view the way you look at equity. When you look at equity, you may today look at some amount of large cap, multi-cap, index, sectoral, etc. So we look at that quite scientifically now, as many investors do, in spreading it across different styles, different types of market caps. It may be similar to do that in debt as well, because in debt, to our mind, there are 3 buckets one must think about. The first is the liquidity bucket, which is money that you keep aside just for the near term. You don't want to take a lot of risk. This is money that is largely represented through the liquid funds or the cash funds or the overnight funds, which is near term, which is safe, it is available on tap, and that's the very simple purpose of that allocation, right? Emergency cash or just money parked away for easy access. The second bucket is what I would call the core bucket of your debt investment. And this is money which you want to be safe, which means that, it has to have the highest quality of assets, and it must try and manage interest rate risk to the best way it can match your investment time horizon. So if your time horizon is 3 years, you should try and look at schemes that will generally give you returns over 3 years. If your time horizon is 6 months, pretty much like we do in a fixed deposit, if you 3-year deposit. And there is a slew of, the idea should be keep and buy securities which are very liquid, so you don't have any pricing mismatch possible. And the third bucket, which is what we would call the alpha bucket, or where you can take some risk, tactical view on debt market, because keep in mind, debt can also return often during cycles much more than equity. It's just a matter of how it moves. And in that bucket, you can get extra returns either by taking duration or taking calls on credit. So you can take credit risk or duration risk. So that's another way to manage risk, right? In many cases, what we come across is that people may have not thought about the bucket as clearly and taken risk while thinking that it's because it's debt, it's all very safe. Keep in mind, debt can also have risk. And one has to be careful and conscious about what's the level and nature of the risk that you're taking. If it's a smaller allocation in your portfolio, one may say no harm done, across the cycle it comes back. But if that becomes the largest part of your allocation, then you have to question that, So first things first, make sure that when you come to debt, you're looking at the allocation right. And this is something we find repeatedly that, investors may not be looking at it as carefully. Coming to your question, Atul, we do think that in an environment where risk is elevated and the stress on balance sheets as well as a lot of the, earnings as well as recovery may be unknown, uh, this may not be the time to add on a lot of risk. So there will be stress, and therefore, if you were to choose to walk into credit risk, one must be very clear that that's the nature of risk you're chasing. At the headline level, it seems like that's an interesting trade or an interesting thing to do, but one must be careful about that because there's a reason why someone is demanding that higher interest rate from these companies, right? But when we come to the near end or the up to 5-year AAA bucket or sovereign bucket, we do think that there is adequate yield available there even now. Keep in mind, globally, interest rates have crashed. So even if you get 5%, 5.5% in a low inflation environment, you still have the benefit of real returns. It may not last forever, and certainly in our last so many years, it's not always been the case that you get paid, positive real returns in debt. But till it lasts, it's still as good. So we would say, keep your money safe in debt, stick to AAA, stick to near terms. If you want to take risk, be very careful about that allocation in your portfolio. And that to us is probably the better way to look at your debt portfolio.
Thanks a lot. I mean, that's so heartening for us because that's a house we have always taken as Scriptbox. So in the debt portfolio basket, which we recommend, we're in the ultra short and low duration funds. And one of the reasons we didn't have any of the Franklin Templeton funds was because they just didn't meet our risk-weighted criteria. So we always say don't chase returns in debt. Be prudent. Look at the return, but the primary reason is capital preservation. So be careful about that. So thank you very much for that. There was a question from Chetan, which says that we talked about diversification and bonds, which we just answered the question. The common question we get asked nowadays, Vishal, is what's the house view on gold? I always personally struggle with that as a asset class, but my wife might kill me for that. But I would love to hear your views on the asset class as an investment destination.
Right. So I think the case for gold is as follows. It is seen as a safe haven during times of volatility. So if you look back, gold rallies when things are uncertain and things are, looking in one sense very risky. And yet again, that seems to be playing out. So it's a safe haven asset. It's also an asset that, over long periods of time, it may have a sort of step function in terms of how it has grown. But it hasn't, over the long term, really been able to beat many of the other productive assets. Of course, it depends on what, time point to point sort of measure. In most cases, we do think you should have a small proportion of your allocation into gold, just because it is a safe haven and it gives you some amount of, stability in your portfolio. But my guess would be that as Indians who are the largest consumers of gold in the world by a margin, we probably have an overweight gold in any case. Just go and look into your lockers and see how much we've got already, right? So if you don't have any gold, by all means, I think, by and large, the 5 to 10% rule is what is advocated. But I'm suspecting that when you add everything up, you already have a fair amount of gold, more than we realize. And therefore, where's the case for buying additionally? If one wants to trade, that's a very short-term view, which is very difficult for us to, give out. A fair amount of climb up has already happened based on this safety trade. So one can't really be sure about how much more upside there may be. But leave that to the traders.
Oh, lovely. Thank you very much for that answer, Vishal. I mean, one of the things I wanted to ask, and maybe we'll wait for some more questions from our participants. You obviously had a phenomenally good run and congratulations for the panel, for people who are listening in. Under the watch of Vishal, IDFC has doubled its size in the last 4 years, from 52,000 crores to 104,000 crores, which is absolutely a phenomenal achievement. So some secrets of success, some mantras Because after all, if you grow your money, our investors grow their money. So what's it taken? Tell us a little bit about the journey, Vishal.
Atul, I really can't take credit for all of this, growth because, it's really our investors reposing faith in us, and a team which has really been, together, and it's a great privilege to be able to lead such a talented, group of people. Having said that, what we try to do are things which are very, very simple. The first principle we've applied is that you keep your product straightforward but disciplined. So, internally we call it being true to label. So if we say this is a AAA fund, this should always remain a AAA fund, because what we don't want to do is take tactical calls and then get greedy in a sense. It sounds easier than it is, but that's the discipline that we apply, which is define the product very well, and then keep it disciplined within the parameters that are laid out. So the products must be distinct. There should be limited overlap. And then after that, we really rely on our channel partners, our distributors, our advisors, the sophisticated, the researchers we have, to be able to spot our products along with others. Because keep in mind, this is only part of a portfolio, so it should perform its part very carefully. So that's one. The second is, we've tried to simplify the communication as much as possible. This is, inherently a complex area. We must recognize that. But what we don't want is our customers not. So to the extent possible, we've taken several steps. We try every day to keep the communication simple, the material simple, and express what we have to, so that most people are getting the right message from what it is that they're getting. And beyond that, something that's helping us during these lockdown times is a fair amount of investment in process systems and digital technologies that allows us to really be efficient in the way we service our customers, as well as our partners. And this is one industry I think we must acknowledge, not just at IDFC, where despite the lockdown and all the disruption, by and large, we've been able to service, both our customers as well as other stakeholders at similar levels of performance as pre-COVID.
Thanks. Yeah, so all that you said, I mean, I could have been saying as a Scriptbox CEO that keep it simple, keep the language simple, be absolutely transparent in what you do. Vishal, there are a couple of questions around, in this time, is lump sum investment better, or should I continue with my SIPs, given the volatility? Have we lost Vishal on the line here?
No, I'm still there.
Sorry, my bad. So yeah, so what are your thoughts around investing in at this time? I mean, so the question from one of the people is around, should I continue with my SIPs, or should I start looking at lump sums because these are uncertain times? And then there's obviously a question around, I'll come back to that on category specific funds like pharma, etc. What would you advise people to do?
So definitely continue with the SIP. I would advocate not getting into the lump sum layer. Keep in mind that we're just finishing off the Q1 sort of earnings season, and as news flows about earnings comes through and things get clearer and clearer, one should expect that the market will not be a straight line. We should anticipate that there'll be a high amount of volatility. Through volatility is to stagger the investments rather than go in as a lump sum. So yes, we've seen a very, very smart pickup in the market over the last 2.5, 3 months. But to believe that it's a one-way street, is something I would caution against.
Okay. And any thoughts on? I mean, obviously, because of the whole health scare, there's a lot about talk about pharma. So I'll give you, sorry, I'm preempting the answer, but I'd love to hear your view. We tell them, trust the fund manager. He will diversify appropriately. Don't chase a specific sector because it's just too much concentration risk. And that's been the house view from Scriptbox, but more than happy to be corrected and have a different view. Vishal.
Yeah, no, I think Atul, that's absolutely spot on. we have to keep in mind that these things often hit us as average investors much after the fund managers and the big moves have already happened. So if you were thinking about pharma, it may have been a very different sort of play than looking at it at, end of July, early August.
But Vamshi, is it? Am I audible or am I interrupting? Sorry.
I can hear you, Atul. I think Vishal's got cut off.
Oh, he's back. Sorry, Vishal. I think we lost connectivity for a couple of for the last 30 seconds. Could you just? I apologize. Could you just repeat what you said? Your audio is not there, Vishal.
Yeah. Sorry, it's okay now?
Yeah, it's much better now. Yeah.
Yeah, sorry. I was saying that, theme is something that I think as retail investors, we should probably stay away from. Themes move very quickly, and, a lot of fund managers would have capitalized on that in, Feb and March, maybe even in April, not in July and August. And, these things move so quickly that for us to keep pace will be difficult. And then going back to Atul, your advocacies of keeping it straightforward, let the fund managers decide what the sector allocation should be, maybe a better way forward.
Thanks, Vishal. Yeah, we're nearly out of time, so I'll ask a last question. And I think this is a common concern for a large number of investors that given the last 3 to 5 years, markets have been choppy. Overall, mutual fund returns have been muted. So as a category, there is a lot of concern. I mean, there are obviously outstanding and exceptions, but as a category, mutual funds, people are sort of saying that is it the right place to put my money, or should I just go to fixed deposits? Ours is saying that if you take a 40-year term, if you took a 40-year view, and you take a every 7-year average, markets obviously outperform fixed income. I mean, equity markets tend to, and if your purpose is growth, then investing in equity is the right thing to do. But would love to hear your thoughts around that. I'm sure you get these questions as CEO from your investors. What is your view?
Right. So I think fair question, and certainly, at times when there are big drawdowns, people are reminded once again of the risk, and then one wonders whether you're better off keeping your capital safe. But keep in mind that, for most investors, post tax and just looking at the returns from other fixed income products, it's not as if a fixed income mutual fund, which is the closest proxy, has underperformed. In fact, when we looked at rolling returns on a net of everything basis, very simple AAA have outperformed fixed deposits for most of their career, 90+% of the time. So yes, there can always be the 5-10% of time when you may underperform, but 90+% of the time you're outperforming a deposit by a reasonable margin. Then there is the additional benefit of liquidity, which really kicks in, and the convenience of making sure that it's part of our portfolio. For equity, there is absolutely no comparison. I think any long-term study will show us that they do tend to outperform. Of course, there is a big bias on what the entry and exit points are, but on a rolling basis, you will see that it does outperform, and therefore SIPs have been so popular. The good news is that coming back to your first question, I do think the structural integrity and attractiveness of the industry is very much intact. In fact, on the contrary, I would say that despite all of this volatility, look at the industry, it's still been able to grow, it's still been able to serve its customers. And when you look at SIP flows, for example, yes, it may have come off from 8,600 to 7,900, But in the larger scheme of things, that's hardly a dent. So one can understand and appreciate that, some people want to be cautious. Incomes are getting impacted. We have to keep that in mind. People are getting laid off. So in that period, people are, being cautious about fresh deployment. That can be understood. But I don't think that impacted the attractiveness of the industry or the product by any means. I think it's a great testimony that despite huge volatility, this is an industry which has been able to really manage through quite seamlessly.
Absolutely. Thanks, Vishal. I mean, I have to thank some of all of our investors online. We've actually grown 40% in the since pre-COVID days, if not more. So it's obviously a testimony to our customers and their faith in the process. And thanks to the industry who keeps the money safe and keeps it growing. So yeah, we're done with our set of questions. And thank you everybody for participating. Last words from you, Vishal, on sort of one last tip for all our investors before you go.
Yeah, I think, Atul, one of the things that the crisis has probably shown us, and before I step into the crisis, very interestingly, in the Chinese sort of way it is written, is a and the second symbol which shows opportunity. So there's always risk and there's always opportunity. So you have to manage to both. But one of the things that people have talked about through this entire lockdown phase in COVID is the need for us to keep it simple and be back to basics. And as an investor, I think we do spend so much time almost worrying about things that are not in our control directly, and forget about the things that are actually in our control. I keep worrying about, which product should I buy? Have I timed it right? Is the expense rate okay? Or is the fund manager okay? But actually, when we all know that, probably 90% of my portfolio results will be based upon the simple allocation that I have, got in that portfolio. Do we spend 90% of our time worrying about that? And I would guess it's the other way around, right? 10% on allocation, 90% about everything else. So stick to the basics. Choose the goal carefully, choose allocation carefully, and everything else will be by and large managed through a very, very simple review process.
Thank you very much, Vishal. I mean, you from a thought process perspective, I think we couldn't be more aligned. So thanks very much for your time. I really appreciate you taking time out during this obviously very hectic period for everybody. And to all our customers and people who dialed in, thank you very much for your time. It's a privilege and pleasure to serve you. Stay safe, stay invested. And please do feedback about how you on the webinar itself. And thanks again, Vishal. We'll see you sometime soon again.
Look forward, and thanks for having me. Real pleasure interacting today. Thank you.
Thank you, guys. Cheers.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully before investing.